Hello everyone and welcome to my YouTube channel. This video continues with the 7th part of the series, How Does Money and Our Global Economic Cycle Work? It starts right after the intro. Stay tuned.
Insights for the informed investor.
Building up assets. What options are there? You have now set yourself the goal of building up a fortune. But how exactly do you do that? Many people pursue the same goal as you and still fail to build up a fortune. To change this, you should read this chapter carefully. After reading this chapter, you will see that there are countless ways to build up your wealth. At the end of the day, it all depends on you. You have to consciously choose one option and make sure that you can maximize your wealth. You will see that this is easier than you might think. Which brings us to the first option, the piggy bank savings book. A normal savings account is the simplest way to accumulate money. This is deliberately referred to as collecting, as you should not expect high returns. However, there are still some aspects that speak in favor of setting up a savings account. One major advantage is that savings accounts are very widely accepted and offer security. With a savings account, unlike an investment in shares, you are not making a risk investment. Of course, the bank could go bust, but that has hardly ever happened in the last century. Another advantage is that you don't have to familiarize yourself with a lot of new things. Many investments require you to expand your knowledge. With a share investment, for example, you have to learn countless key figures and know how to use and interpret them correctly. You don't have to do this with a piggy bank savings account. It's also a good way to get started, as you can use a savings account to train the discipline you'll need for real investments later on. What exactly does that mean? You will simply learn how to set aside a certain amount of your income each month. Another decisive advantage is that you can deposit the money directly. This means you don't have to worry about paying the money into a separate reference account or a special current account. If you want to collect money as a first step, then the savings book is recommended. The disadvantages are just as obvious as the advantages. One disadvantage is that you receive a relatively low interest rate these days. You should also pay attention to the amount you have available each month without having to give notice. This varies from provider to provider, so this information can give you a big advantage. Also, make sure that you choose a provider with whom you can invest money easily and efficiently. Call money savings account and fixed term deposit. The next option would be to open an overnight money account or a fixed-term deposit account. But what is call money anyway? As the name suggests, a call money account gives you daily access to your income. You can invest as much as you like in a call money account at a current call money interest rate. The main difference between a current account and a call money account is that you do not have a fixed payment function with the latter. You now know what a call deposit account is, but what is a fixed-term deposit account? In principle, a fixed-term deposit account is similar to an overnight deposit account. The main difference, however, is that you have a fixed investment period. You conclude a contract in which the interest rate for your account and also the term are determined. You can only dispose of your money at the end of the term. What are the advantages of these investment options? The advantage of a call money account is that you can access your money at any time. You are flexible and can also withdraw the money in an emergency. However, you should be aware that the conditions can be changed at any time. This is different with a fixed-term deposit account. Here you have a fixed interest rate. So if you use a fixed-term deposit account, the bank must give you the interest rate that you have agreed with them in a contract. Another important point is that you have limited availability with a fixed-term deposit account. This means you are no longer as flexible and have to plan for the long term. However, this is not such a bad thing. You will learn how best to manage your income and maximize it in the long term. In addition, you can always choose any investment period you like. Accordingly, you should not spend too much time worrying about whether you really need your money for that period. But what is the decisive advantage over a savings account? Quite simply, you have a higher interest rate. This pays off in the long term. All you have to do is think back to the example of compound interest. A simple investment can definitely pay off, if you plan the investment period well and get a good interest rate. You also have the advantage with a fixed-term deposit account that you can plan the interest income. This naturally offers you a certain degree of security. However, if you are more risk-averse, you can also make use of the other investment options presented here. The principle is simple. The higher your risk, the greater your return can be. Home loan and savings contract. It can be worthwhile. A building society savings contract can be worthwhile. Regardless of whether you invest in one for yourself or your children, it will pay off in the future. But one thing is certain. You should plan a long-term investment horizon for a home loan and savings contract. You will never be able to achieve a high return overnight. What are the advantages of a home loan and savings contract? You should always look at the advantages of a home loan and savings contract from a long-term perspective. One decisive advantage is that you may have very low interest rates during the savings phase, but this is balanced out by the fact that you receive a very favorable loan after this phase. You also have the advantage of being able to make unscheduled repayments. Some providers also offer rates that allow you to repay the entire loan without notice. This is not usually possible with a normal loan. The high degree of flexibility you have with a home loan and savings contract allows you to realize your dreams in the long term. You can also have your building society savings contract supported by your employer. Your employer will give you capital-forming benefits. You can get these back from the state if you do not exceed a certain income limit. There is also the housing construction premium that you receive at the end of each year. Furthermore, you should not neglect the employee savings allowance, which is also available. As you can see, a home loan and savings contract is not primarily about the return. The return is of secondary importance, as you will later receive a very favorable loan. The option of unscheduled repayments gives you the advantage of being very flexible. Do you have a dream of owning your own home and want to realize it as quickly as possible? How about using a home loan and savings contract? The advantages will pay off in the long term. Capital life insurance. Have you ever heard of this term? What is endowment insurance? An endowment policy is simpler than you might think. You conclude a contract with an insurance company. This contract includes two benefits: the benefit in the event of survival and the benefit in the event of death. If you see the contract through to the end, you will receive a sum X at the end. This is called the endowment benefit. The second benefit is self-explanatory. In this case, the sum is paid out to the surviving dependents. The amount of benefit you receive varies depending on the contract. With some providers, you may even receive a higher sum in the event of death, as the tariff from these providers is simply higher in this area. What are the advantages of this insurance? One key advantage is that you have protection for your old age. It is also a secure form of saving, as you are offered a guaranteed interest rate. Of course, you should make sure that this interest rate is high enough. However, you do have death cover. Have you ever wondered what your family would do if you died? Many families are not insured against this eventuality. It can happen in an instant that you lose the light of life. Another advantage of this form of savings is that you receive a profit participation. However, you should make sure that the guaranteed interest rate also falls over time. If the guaranteed interest rate is not higher than the annual inflation rate, it is usually useless. Insurance companies usually advertise that they can offer a guaranteed interest rate. Under no circumstances should you be misled by this point. Therefore, make sure that you take a detailed look at the interest rate offered and the other options. At this point, it should again be pointed out that you have a secure investment. This means that the interest rate will not be as high. With increasing risk and possibly a different investment, the interest rate may well be higher. The company pension plan. Countless people still fall back on company pension plans today, but when is it actually worthwhile? Basically, it can be said that a company pension scheme is a supplementary pension. This supplementary pension is handled directly by the employer. You should also bear in mind that there are differences in the structure of this pension. For example, there is the classic employer-financed company pension scheme. In this case, the employer alone pays the amounts for the later pension. However, as an employee, you can also use part of your gross salary for the company pension scheme. If you claim an amount of up to USD 268 per month for the company pension scheme, no Social Security contributions are due. You do not have to pay tax on amounts up to USD 536 per month. The advantage of an employee-financed model is only worthwhile if you are particularly old. When taking advantage of the option of a company pension, make sure that you will have to pay tax on it later. The procedure for taking out a company pension is simpler than you think. Go to your employer or ask the head of your HR department what pension options are available in your company. If the employer finances the pension, you should participate. However, it should also be pointed out that you do not necessarily have to resort to a company pension scheme if you want financial freedom. You can successfully become self-employed. This will allow you to maximize your income in the long term. You then invest part of your income in a separate investment where you can generate high returns. You have thus created your own basis for retirement provision, ETFs and equity funds. Now let's move on to a variant of retirement provision that is somewhat less secure, but still offers a good return. With an equity fund, you can easily build up long-term assets. Of course, you will have to make regular investments and will not have the money immediately available. In principle, an ETF is a replica of a stock market index. If you consider the DAX share index, for example, this index shows the value of the 40 largest companies in Germany. If an ETF now replicates the DAX, you would buy exactly these 40 shares. These would then develop in value in the same way as the DAX itself, for example. The unbeatable advantage of ETFs is that they represent a very secure risk investment. This is partly due to the fact that they track an entire index. This ensures that a return is distributed each year that corresponds to the performance of the respective index. The advantages are therefore obvious. If you no longer want to simply save money in a savings account and are looking for an efficient risk investment, then you should turn to ETFs. With these, you have a very simple advantage. You don't need to have any great prior knowledge of the stock market. You can also focus on other income opportunities while your ETF assets grow. It's up to you to decide to what extent you can provide for your old age with this investment alternative or not. In addition, there are no high fees when trading ETFs. This is due to the fact that many people own this investment. You should not be put off from investing in the stock market. However, make sure that you have a sensible broker to support you. You should also make sure that your assets are secure. It is worth comparing the various providers to maximize your own equity. If you've enjoyed the video so far, don't forget to like it. Subscribe to my channel and activate the bell to give the channel added value and support my channel for free. Shares. When it comes to shares, many people turn their heads from the outset. However, shares are not as bad as many people think. Ask the people around you what they think about shares. The answer will usually be as follows. You can't make money with shares. All those shareholders are just speculating at the end of the day. If you come across such answers, you should not allow yourself to be influenced under any circumstances. Ask yourself explicitly how great investors such as Ray Dalio or Warren Buffett have made their fortunes. Realign your mental attitude and free yourself from the negative beliefs that are anchored in society regarding this topic. Once you have internalized your new positive beliefs, you can start investing in the stock market. To put it simply, you can imagine the various investment options as follows. You pay low interest rates for the security of a particular investment. On the other hand, you can earn an attractive interest rate on the stock market. Of course, such an investment is subject to the residual risk that the market may collapse. In this case, you would of course lose part of your capital. But in this chapter, you will find out how to deal with shares correctly. One thing is certain. If you invest in shares, you can benefit from many different advantages. The biggest attraction is, of course, that you achieve higher returns, and the company in which you own shares can also pay dividends at the end of the year. The dividend is the biggest advantage. Even if you continue to hold the shares, you will receive returns that you can have distributed to you at a given time. Depending on which shares you buy, they may be subject to high price fluctuations. In this case, you should keep calm, because with the right investment, the share can also generate a high return. It is natural to make mistakes on the stock market and lose capital as a result. If you lose capital, you should not give up immediately, but learn a lesson from your actions. Another major advantage of shares is their liquidity. While the respective shares are being traded, you as a shareholder can buy or sell shares at any time. In addition, the attractiveness of the market is increased by the fact that numerous shares are available on the market. Furthermore, shares on the market can be used very flexibly. You can invest for the long term, but also make short-term investments. Depending on your shareholding in a company, you may be able to secure voting rights. However, you should make sure that you own a certain number of shares. Of course, many people are invited to the annual general meeting, but not everyone has the same voting rights. This varies from person to person, and accordingly, you should also be aware that small shareholders may not be considered for decisions. Now that you have a rough overview of the main advantages, you should of course also be aware of the disadvantages. When buying shares, there is always a risk. Under no circumstances should you be put off by this risk. Enjoy the thrill of investing. In times of crisis, a company may experience a crash, and with it the shares of the company in question. If this is the case, you should not panic under any circumstances. Many companies recover over time. If you want secure returns, you should invest in companies that have a large market capitalization. These companies have a lot of market share, which you can of course use to your advantage. You should also be aware that you will not have fixed returns. Returns on the stock market are always variable, so you should be aware of this. Is that a disadvantage? This question can be answered with both a yes and a no. If you have sufficient experience and know how the market works, then this is an advantage for you. However, if you are very risk-averse from the outset, this can lead to you losing capital. The large companies that have been established on the market for many years are the ones that are safer to start with. You should therefore concentrate on these companies at the beginning. Over time, you will gain experience, which you can then apply to other shares. Another disadvantage is that tax liability has applied to shares since 2009. As a result of the final withholding tax introduced in 2009, capital gains have become fully taxable. This means that the tax advantages of shares are lost. However, you should always look at the bottom line. There is also an allowance for gains from shares. You should make full use of this, especially at the beginning. Over time, you will find further investment opportunities. As long as you keep reinvesting your capital, you have the advantage of not having to pay as much tax. When trading shares, your mental attitude can determine whether you are successful or not. This is because you need to be able to assess the market optimally, even in difficult times. Another important point is that you also need to look at other market participants. You can work with key figures to find out how a price would develop. However, psychology also plays a decisive role in the stock market. Many people are active in trading, which means that you should also be concerned with the right attitude of market participants. For example, it is important that you consider how market participants react to certain news. A company has laid off 100 employees. This will cause the share price to rise. The reason for this is quite simple. The company now has low personnel costs. This gives it the advantage of being able to make a larger profit. This profit is ultimately reflected in the balance sheet. Finally, a comparison should be made between the investment presented here and the investments presented above. Basically, it can be said that no investment can be judged to be the better one across the board. However, over time, you will have to realize that the interest on a normal, risk-free investment is simply no longer sufficient. You will have to look for alternatives where you want to invest your money. One of these alternatives is the stock market. Take your cue from what the experts in this sector are saying. As mentioned in the previous chapters, it is very easy to gain knowledge these days. You can find books by well-known investors on Amazon and many other platforms. They write down their theories and strategies in these books. Of course, you need business knowledge, but you can also acquire this knowledge over time. So don't worry if you don't understand so much at the beginning. In contrast to the company's opinion, there are shares that are a somewhat safer alternative. Start with these shares and work your way through the market. Eventually, you will get to the point where you are also dealing with high-risk stocks. At this point, you will have built up extensive market knowledge. Learn constantly. You can learn something new about the stock market every day, and you should take advantage of this. Therefore, make sure that you continue to educate yourself with courses, seminars, or books. This will help you to build up long-term wealth. Another crucial tip is to be patient. Patience is the key to success. This applies not only to shares, but also to any other investment you know or will come to know. With a little patience, you can move stones. The market is constantly changing, so you should keep your emotions in check. Many people realize losses because they are not patient. This leads to them taking a negative profit and never wanting to hear about the stock market again. If they then take a quick look at their share 4 years later, they see that it has quadrupled in value. As you can see, patience can definitely pay off. You should decide for yourself whether you always want to play it safe or keep the risk in order to ultimately achieve a higher return. Bonds. Now that you have gained a comprehensive insight into the world of shares, this chapter will focus on bonds. Bonds are also securities alongside shares and the various investment funds. By investing in bonds, you lend your money to the issuer of the respective bond. Ultimately, you receive your money back at a certain interest rate. The basic principle is similar to that of a loan. The advantages of a bond are obvious. On the one hand, you have the advantage of less fluctuation than with shares. Furthermore, you are independent of developments on the stock market, which means a lot to many people. Because you are independent of the stock market, you don't have to worry about how the DAX performs, for example. The final advantage is that you receive a higher return than with overnight money or fixed-term deposits, for example. However, bonds not only have positive aspects, but also negative aspects. One disadvantage is that you can generally achieve a lower return than with shares. If the interest rate varies, this can also lead to the value of the bond in question also varying. Another key risk is that the issuer of the bond could file for insolvency. Therefore, when choosing a bond, pay attention to who the issuer is. Find out more about the person or company in question. You should also pay attention to whether the issuer is a company. Young companies in particular resort to this type of financing, as it is of great benefit to both sides. However, you should be aware that many companies go bankrupt in the first 5 years. You should therefore pay even more attention to who wants bonds. This form of equity maximization is a simpler form compared to ordinary shares. Please note, however, that you have to weigh up the risks yourself. Precious metals. Precious metals are another investment alternative that you can make, but what distinguishes them and what advantages do they offer you? Precious metals have one major advantage over normal investments. They only occur in nature to a limited extent. This resource is therefore scarce. In addition, precious metals have properties that are valued worldwide. You will no doubt already be familiar with some precious metals. These include gold and silver. However, silver is also often in demand for industrial purposes. Accordingly, you should note that the price of silver is more dependent on the economy than the price of gold. If you look at the development of the latter metal, you will notice that it is very stable. Another important aspect is that the biggest price jumps occur when the world is in a financial crisis. What is the reason for this? It's easier than you might think. The price jumps in times of crisis can be traced back to the fact that precious metals offer a safe alternative. When the financial market crashes, many people invest in this alternative investment. Ultimately, this causes the prices of metals to rise in times of crisis. If you look at the financial crisis in 2008, you can understand this even better. One thing can be said in any case: the physical possession of precious metals is a great advantage for private investors. Gold coins in particular have proven to be very lucrative in recent times. They have a low denomination and can be easily transported from A to B. Gold coins are also a recognized means of payment. You should definitely include precious metals in your portfolio. When you make investments, diversification plays a crucial role. The more you diversify, the better it is. Of course, you should not diversify with an amount of 100 USD. If you spread this amount over 10 different investment opportunities, you have a major problem. This is that you simply won't have too high a return. In the worst case, your denomination may even eat up your return completely. This is due to the fact that investments are always associated with costs. With a low denomination, the costs can exceed the return sooner than you realize. When investing in precious metals, make sure that you keep checking the amount of your holdings. Having a safe amount set aside is never a bad thing. As you gain experience, you will also be able to tell when an economy is weakening or not. At these times, you can continue to invest your capital in precious metals. Ultimately, this approach will ensure that your capital grows despite the ongoing crisis. However, this is only possible for investors with a great deal of experience. You need to have experienced the market cycle many times in order to anticipate such crises. Real estate. Do you have one or more properties? Then you have made a strategically sound investment. Many people have recently been able to maximize their wealth with real estate. The strategy is not as complex as you might think. When should you rent out a property and when should you not? One argument in favor of renting out a property would be that demand in your area is very high. Another aspect is that you will have to pay speculation tax if you have owned your property for less than 10 years. You should also bear in mind that you should rent out your property even if you have limited financial resources. The main reason for this is that the maintenance costs of a property are usually very expensive. Renting out a property makes sense so that you can protect yourself optimally against these costs. If you think long-term, you will realize that you can achieve a higher return by renting out your property. All you need to do is understand the difference. Would you rather have a one-off sale proceeds, or would you rather have a certain monthly rent that you can invest elsewhere? If you consider this question carefully, you will find the ideal solution. It is also generally the case that the value of a property increases over time, especially if the property is close to a major city. You can assume that its value will increase. If you would like to move into the property yourself at a later date, but do not need it now, it is also advisable to rent it out. This means you don't have to bear all the costs yourself and can move back into the property later without any problems. In addition to the advantages of renting out a property, there are of course also a few things that speak in favor of selling it. If you have invested your money in several investments, you should consider the following. If the return from other investments is higher than your rental return, then a one-off sale may well be worthwhile. Furthermore, you should also sell the property if you can pay off a large loan as a result. In addition to these two aspects, you should bear in mind that you must keep your property for at least 10 years. This will ultimately give you tax advantages. So what would be an ideal strategy? It's very simple. Buy an inexpensive property near a large city. You then rent this property out for 10 years. You can usually pay off your loan with the monthly rent without any problems. As soon as the 10 years are up, you have two options. You can either move into your property yourself or sell it. Depending on how high your return on other investments is, you can make a large profit on the sale. You can then use this profit to buy a new property, which you can then move into. This is sometimes the most effective strategy for avoiding speculation tax and still making a high return. The examples provided here are from Germany. Different countries have different savings options. Please inform yourself in advance before you start investing your hard-earned money in your local currency. Please note my disclaimer in my video description. Thank you. This was the 7th part of the series. How does money and our global economic cycle work? I hope you enjoyed the video, so I would be very happy if you give me a like, subscribe to the channel, and activate the bell. That way, you won't miss any more videos from me, and you'll be informed immediately when a new video is published. Thank you for watching the whole video, and see you soon. Disclaimers. This video does not represent financial advice, and I am not a financial advisor. When investing, your capital is at risk. Investments can rise and fall, and you money get back less than you invested. Past performance is no guarantee of future results. My videos may contain advertising, recommendations, or product placement, both in the video itself and in the video description or comments. However, I only feature platforms that I believe in or use myself. In most cases, I do not receive any services or payments from third parties for the creation of videos. I use affiliate links to help me finance this YouTube channel. There are no additional costs for you, but you support me so that I can produce more free videos for this channel.